The US dollar is extremely vulnerable as inflation and data continues to cool in the United States. Let's break down all of the key fundamentals and technicals. Guys, I want to start off with the dollar. We're going to get onto everything in terms of, because we've seen some moves overnight, which we'll get onto with RBNZ, NZD. There's obviously quite a few talking points, but I just want your attention on the dollar again, because we saw some decent sized moves there yesterday for the greenback coming under some pressure. And obviously I do this a lot where we go over, just continue to paint that picture. And I do that for a very, very reason. Obviously, throughout my early days as an analyst, I had to keep going over the talking points, all the narratives, so that it ingrained in my head. So it became second nature. So it was effortless in thinking about it. It was effortless in making decisions when I executed on the charts, right? So this is why I want to paint the picture for you guys again, okay? So yesterday, we saw the dollar coming under pressure. We already know why. Okay, we're going to talk about that in a moment, but let's just paint the broader picture once again so that we are fully aligned with these fundamentals that are driving the greenback. So far, obviously, on the monthly, you can see clearly for the last couple of months, the dollar's ran out of momentum. We had started topping out here between the month of May and then ultimately losing ground there in July. Okay. Now, we'll get onto that again, but still painting the picture. At the commence of 2024, which we at the TFTC, we were all over this, right? In terms of this upside pressure, we were all over it. We had our finger on the pulse. The reason for this upside pressure and why dollar really picked up some edge was because at the back end of 2023, which we were talking about, markets were delusional about those rate cut pricing for all these. Remember, they're pricing in rate cuts for every month of the year. Okay. Now, that got pushed back because as we were ready for, data was solid from the United States, inflation was still high. So that only meant that we needed to have a higher for longer stance with interest rates from the FOMC. Now, stay with me. We're going to pull all this together. It's really important that you stay with me. Guys, you see all this information that I'm putting into this video, it just comes like that, right? It's second nature to me. And the reason being is because obviously I have that experience. Nothing beats experience in these markets. Everything that I have learned, I've been able to simplify, because a lot of information that's out there in the public domain is extremely overcomplicated and a lot of jargon, and it doesn't make it easy for the everyday person, everyday trader trying to learn macros, understand, why has the price just spiked here because of this fundamental reason? I don't understand it. Because all this information's over, complicated. But for me, all these years, I've been able to simplify it, make it easy and digestible and actionable for the everyday trader. And that's exactly what I've been able to do. And I've put together in my fundamental bootcamp course, which you can obviously check out if you're willing and keen to really level up your whole game. You can thank me later on that. Anyway, let's continue with the video. Okay. So the dollar had all that edge. So let's repeat the three main points there, why the dollar had edge. Inflation remained high and sticky. Economic data was still solid in comparison to a lot of the dollar peers, United States peers. And then the FOMC rates, their stance was higher for longer with interest rates. Now here, if you can see, at the start of July, we started losing momentum. Why? Well, if you look back at these figures in July, you can see, you can see inflation started to cool sort of May, June time, where we're sort of topping out. And then ultimately we came out under some pressure there. Inflation started to cool. Okay. Inflation in the United States started to come down. Then we had Jerome Powell speaking. He made a speech, remember, to Congress. He's testifying to Congress where he acknowledged we've made substantial progress in bringing inflation down. So a couple of points here, inflation coming down, then that being acknowledged, the progress that being made towards the central bank's target, okay, dovish. And then within recent times, which we're going to go over in a moment, just look at some examples, data starting softening. So those three things of which the dollar had edge before, diminished, gone, out the door, bye. So now the dollar has lost its edge. Do you remember weeks ago? Guys, please tell me you remember weeks ago I said this, right? The dollar was thrown back into the mix with all the other currencies. I said it weeks ago. I did. The dollar had been thrown back into the mix, and I said it had lost its edge. It lost it. We said this weeks ago. And look at it. Look at the dollar now. This mid 102 region and remains vulnerable to some further potential selling. Okay, now stay with me. It's really important. You have to stay with me, guys, because we're not finished painting this picture. Let's just look at yesterday, for example. We had PPI data. Remember, this is the producers' prices. We've got key data in terms of inflation metrics. We look at the consumers' prices, right? This is the real key one, because it's what our costs are as a consumer. How much does it cost us for our everyday goods, for our basket of goods when we're going shopping? Our energy bills are still important. Obviously, there's a bit more volatility there, our fuel prices, all of that. This is important. But then the PPIs is the producer's prices. What does it cost the producer that are providing these goods to us as a consumer? What are their costs? Because if their costs are higher, right, they're going to pass that cost on to the consumer. If their costs are lower, they're going to bring down that cost naturally for the consumers. Okay, do you understand that? So the producer's prices. Now, the producer's prices here yesterday, cooling here, the core, which is very important, it came down to 0%. That's dollar negative. Why? We'll talk about it. Lower than expected. Previous even revised lower down from 0.4% to 0.3%. That's dollar negative. Month on month, 0.1% lower than 0.2 expected, 0.2 previous. Now, if the producer's prices are coming down, that's disinflationary. Okay, so this, remember I said about yesterday how it will set us up, setting us for the tone of potentially ahead of the CPI today for potentially softer CPI. Now, if you look at the CPI data here, the figures are expected to remain a little bit sticky here on a month-to-month basis, right? Even year on year expected to remain steady at 3%. But there's a number of indicators heading into this, i.e. PPI yesterday. If we go to last week, okay, actually not last week, the week before last, let's continue to paint the picture. Stay with me, guys. You want to become a macro beast, right? You want to be able to convert these into trading opportunities. Well, stay with me then. Look, employment cost index. So this is the costs, right, associated for labor that's being paid, all right, by the government. As you can see here, government pay. Price for businesses, not just government, but businesses. Prices for businesses and government to pay labor force. Look, that's cooling. That's disinflationary, right? The cost for labor is decreasing. That's disinflationary. And then here, look, data just hasn't been great on a labor market level. Average earnings coming down to 0.2%. If wages are coming down, remember, if what people are getting paid in terms of money is coming down, we're going to look at the charts in a moment. If what's getting paid is coming down, right, wages are coming down, what do you think people are going to do if they're getting paid less? If naturally wages come down across the country, there's going to be less reason or less desire to want to go out and spend if wages are coming down, right? We only really naturally consumers, as economics 101, if we're getting paid more money, we're going to go out and spend and stimulate inflation. But the fact that wages are coming down, potentially less spending, that's disinflationary. Okay, inflation should be lower, coming down. The amount of jobs being added, worse. If we've got less jobs being created, less people in the workforce, that's less people out stimulating the economy, stimulating prices, and disinflationary. Unemployment rate ticking higher. We've got more people in unemployment, disinflationary. Okay. Now stay with me. The week before that, look at this, by the way. Remember, I always say, don't overlook these orange folder data because it's important. GDP price index, right? You guys know what this is now. I know you do. This is the prices of all the goods and services that make up that GDP number here. Look, disinflationary, 2.3%. The prices there are coming down. So let's fast forward again today. All right, let's fast forward again today. Takes us on to the CPI figures. You see, obviously yesterday we had that downside pressure for the dollar index. Look at that. Remember, we were speaking about this at the start of the week. We're speaking about this heavy area of resistance, heavy area of supply that just wasn't being broken down. We're looking for those rejections, as we marked up here, for this key zone. And we faced big rejections there. And we've now come down to this key zone because really via the dollar index, when you look left here, you can see us key zone. But ultimately, this could very well give way. Obviously, if this ends up giving way, where we've marked up, we've got those lows. And I said to you guys yesterday, the significance of this is significant because this level marks where we commenced that trend to the north for the dollar index because it had all its edge. Now you can see this is pivotal. This is substantial. This is enormous. The fact that we come down and pare back that move. And it goes back to what I was saying at the start of this video, where I was saying the dollar edge gone. That is just final nail in the coffin, gone. Okay. Obviously, things can change and there's a lot more things to talk about. And I just don't, we'll get into that. I know I keep saying it about this series, but time, right? It's all divine timing. Give me time on it. It's coming, right? I just need, yeah, you get the point. So we'll get onto that. We're going to also keep an eye on retail sales, as we said, which is due out tomorrow, because it just potentially fits with this narrative. You know how we got those three things about inflation cooling, FOMC stance softening, but then also the economic data. Are we further getting that narrative being driven? If data comes out softer down the retail sales level, we have reason to, right? We went over the worsening in the labor market, prices coming down. Perhaps we're getting ready for softer retail sales here in this latest reading. If all that filters through into this reading, let's see. Okay, so a lot of key talking points, which is just allowing, you know, I'll talk about dollar pairs in a moment, actually. I wanted to mention something else while still on the topic of dollar. Now, if you look here, just markets, this is markets. Remember, I told you yields are very important that we follow yields, okay? So this is the 10-year yield, okay? And you can see yields are coming down as well. You can see them coming down across the board. That's the 5-year. That was the 10-year. This is the 5-year. This is 2-year. Remember, if yields are coming down, that's market's way of getting ready for lower interest rates. Because remember, if there's lower interest rates, right, the rate of return that a foreign investor gets when they're investing in the United States, of course, yields coming down. So the yields, typically yields go first. You can see how much of a decline the yields have been on. And obviously, you can see that with the, you know, if we just let's just bring up 10-year. See that heavy decline there obviously matches what we're seeing in the Dixie, but really yields lead the way, okay? Because at the end of the day, if yields are going to be higher, if rates are going to be higher, yields are higher, then of course that's going to attract investment into the United States. How do we invest in the United States? Dollars. So yields first, then of course dollar follows. Now, if you look at some of the dollar pairs, obviously we've seen some significant moves here, which we'll get into detail in terms of specific trade ideas in a moment, but you can see the way euro, for example, taking advantage of this dollar weakness here. We had a bit of an inverse head and shoulders there, breakout of that neckline, extending to the north, coming up to this key area of 110. Okay, they're just taking advantage of this dollar weakness. We had GU, Aussie dollar, as I said to you guys earlier in the week, has been one of those better performers. Okay, and the reason being, look at that weekly big bullish reversal candlestick there, followed up with some big buying this week as we were looking for. And the reason for this outperformance as well, you know, when you look at, for example, GU, which had been, you know, finished in the red last week. Euro was not the best of performance last week, but obviously filling that wick to the upside as well today. But if you look at Aussie dollar, as a decent performance there, and that's because we've got this divergence forming, okay, with the RBA and other major central banks, where the RBA is still talking about potential rate hikes, you know, to try and bring down inflation, which is supporting AUD. You see some decent performance with AUD across the board at the moment, all right? So yeah, some big talking points right now. As I say, I just was painting that picture for you. Dollar still remains vulnerable. Let's keep an eye on those CPI figures today, and then obviously retail sales tomorrow. All right, let's get into everything else now. So guys, I hope you found value again in today's video. As I always say, this is just a snippet taken from one of our TFTC premium rundowns, where on a daily basis, we are breaking down all the key economic data points and what they mean, all the key fundamental themes and narratives that are driving the assets, the prices of the assets that we are trading. And then we look at how do we capitalize on this information? How does that translate on the chart and turning that into opportunities? You know, I think it's very key over these 15 years I've been in these markets, having your finger on the pulse with those macros, and they don't have to be overcomplicated. We really simplify it, but having your finger on the pulse with those can really provide you that edge in giving you consistency and helping you to have longevity in this trading game. So you can check that out in the description of the video, along with the TFTC Fundamental Bootcamp. But otherwise, continue to enjoy these videos. Keep me motivated by smashing up that subscribe button, smashing up the like button, drop a comment below. And I also want, you know, I want you to do. I want you to stay lit. I want you to stay blessed, and let's get it.